Welcome back, everybody, to the deep dive. Today, we're going really deep on something that might sound kind of intimidating at first.
Yeah.
Debt cycles. We'll be using Ray Dalio's principles for dealing with the changing world order. And
Great book.
it is a great book. It's about way more than just numbers, believe me. This is about understanding those, hidden forces that shape our world.
Absolutely. I think that's a really good way to put it.
Yeah.
Dalio's book gives us this framework for understanding these periods of boom and bust that have been happening for centuries and impacting everything from economies to empires.
Yeah.
And what's so fascinating is how he uses all these historical examples like the Weimar Republic or the 2008 financial crisis to show that these patterns, they're not random. They tend to repeat themselves.
Yeah, it's almost like a financial detective story, You start to see these clues, these recurring themes, and it makes you think, are we just walking blindly into the same traps over and over again?
It's a big question, right? Are we doomed to repeat these mistakes? And Dalio says, they're not inevitable, but understanding how they work gives you a huge advantage. And one of the things he does is break these debt cycles down into distinct phases, almost like a life cycle.
Okay, so let's unpack this life cycle. I'm guessing it starts with good times, right?
Yeah, exactly. It often begins with an early expansion phase. Think
Yeah.
rising debt, easy credit, low interest rates.
Mm-hmm.
This creates a sense of optimism. Asset prices go up. Everyone feels like they're winning.
Sounds familiar, right? It's that classic boom period, the roaring 20s, the dot-com bubble. Everyone's feeling good, maybe a little too good.
Right.
So that's when things start to get a little wobbly.
Right. That's when we might enter what Dalio calls the bubble phase. Debt keeps piling up faster than incomes, and things become unsustainable. We see speculative investments, risky lending practices, and this widespread belief that the party will never end.
Well, that's the thing about bubbles, right? It's hard to see them when you're in the middle of them. Everyone's drinking the Kool-Aid.
Exactly. And then comes the top. Something triggers a shift. Maybe central banks tighten monetary policy.
Okay.
Interest rates rise, or some major event shakes confidence, and asset prices start to fall, and all of a sudden, that mountain of debt doesn't look so manageable anymore.
I'm already feeling anxious.
Yeah,
This is when things can really spiral, right?
unfortunately, yes.
Yeah.
We enter what's often called the depression phase. Debt defaults rise, lenders start to panic.
Yeah.
Credit markets freeze up, and this is where you see those classic images of bank runs, businesses failing, unemployment skyrocketing. Think the Great Depression.
Yeah.
Think 2008. It's a time of real economic hardship.
Okay, so we've gone from champagne wishes and caviar dreams to breadlines. Is there any way out of this mess?
Well, Dalio suggests that if things are handled well, there can be light at the end of the tunnel. He calls it the beautiful deleveraging.
Beautiful deleveraging.
Yeah,
That sounds almost hopeful.
it can be. This is where policymakers have a crucial role. They need to reduce the debt burden, restore confidence in the financial system, and stimulate the economy. Think austerity measures, money printing, debt restructuring.
Yeah, I imagine that's an incredibly difficult balancing act, right? You're trying to address the immediate crisis without setting the stage for future problems.
Absolutely. And what Dalio emphasizes is that understanding these cycles, recognizing the signs, and knowing those potential policy responses, that's what can help us navigate these turbulent times more effectively.
So it's not just about being a financial detective. It's about being prepared for the storm. One of the most powerful examples that Dalio uses to illustrate these ideas is the hyperinflation in Weimar Germany.
Oh, yeah.
Talk about a cautionary tale.
It is a stark example of how quickly things can unravel when debt spirals out of control. Imagine Germany after World War I, crushed by war debts, facing political turmoil. This is where our story of hyperinflation begins.
It's fascinating and terrifying at the same time. You're about to tell me about wheelbarrows full of cash, right?
Exactly.
Yeah.
Germany, desperate to pay its debts and facing all this social unrest, turned to the printing press. They just printed more and more money, hoping to just inflate their way out of the problem.
Makes sense.
But as they printed more,
Yeah.
the value of their currency plummeted.
It seems almost counterintuitive, right? You print more money and somehow things get worse.
Yeah,
But it makes sense. I mean, it's like flooding the market with anything. It loses its value.
precisely. And the consequences for everyday people were devastating. Imagine working your entire life only to have your savings become worthless overnight.
Yeah.
That's the devastating power of hyperinflation.
Wow. Okay, so that's a stark example of how things can go wrong. But surely we've learned from these historical mistakes, haven't we? I mean, the 2008 financial crisis wasn't that long ago.
Yeah, the 2008 financial crisis is a great example of how these historical patterns, they can resurface even in a modern interconnected world. It shows us that while the players might change, the underlying dynamics of debt cycles can remain eerily similar.
So we've covered some of like the big scary crashes, but Dalio doesn't just focus on the dramatic collapses. He digs into a whole range of debt cycles in his book, from the 1930s Great Depression to the more recent 2008 crisis. And what I found fascinating was how he provides these detailed like chart decks for each
Oh,
case.
yeah. They're amazing.
Yeah.
Those charts are incredibly helpful. They show all the key economic indicators, the policy responses, the market movements. It's like getting an X-ray of the financial system during these critical periods.
Exactly. It's not just stories, it's hard data that backs up his analysis.
Yeah.
So with all that data at our fingertips, let's zoom in on a specific case that feels kind of eerily relevant today. The 1990s debt cycle in Japan. I remember hearing about the lost decade, but I never really understood what happened.
Yeah, well, Japan's story is a classic bubble followed by a long and painful hangover. Their economy was booming in the 1980s, fueled by easy credit and this massive asset bubble. Much like the roaring 20s in the U.S., people thought the good times would last forever.
And then reality hit. Was it a sudden crash or more of a slow deflation?
It was more of a slow bleed. The bubble burst in the early 1990s, and Japan entered this prolonged period of economic stagnation. Policymakers tried everything, lowering interest rates, fiscal stimulus, bank bailouts.
Wow.
Nothing seemed to work. They were stuck in this debt trap.
It's almost like they were trying to revive a patient whose vital signs were just fading away. What were some of the key takeaways from Japan's experience, besides the obvious, don't let a bubble get out of control?
Well, one major takeaway is that dealing with a debt crisis, especially when debt levels are high and asset prices have plummeted, is a marathon, not a sprint.
Yeah.
There are no quick fixes. Japan's experience also highlighted the danger of these zombie companies.
Okay, zombie companies. That sounds creepy.
Yeah.
What are those exactly?
Yeah, so imagine a business on life support, kept alive by government subsidies or cheap credit, but contributing very little to the overall economy. That's a zombie company.
Right.
They can drag down growth by diverting resources from, more productive areas.
Ah, so it's like clinging to the past instead of embracing new growth. Makes sense. What other historical parallels can we draw from Dalio's work?
Well, let's shift gears and look at the 1997 Asian financial crisis, which offers some important lessons about the risks faced by developing economies.
That crisis really shook things up globally, didn't it? I mean, it started in Thailand, but the ripple effects were felt worldwide.
Exactly. And one of the key factors that made this crisis so severe was the reliance on foreign currency debt. Many Asian countries had borrowed heavily in U.S. dollars, assuming that exchange rates would remain stable.
Uh-huh.
But when their currencies depreciated sharply, their debt burdens became unsustainable.
It's like taking out a mortgage in a foreign currency and suddenly your income is cut in half. That's terrifying.
It is. And it's a risk that many emerging markets still face today, especially with rising interest rates in the United States. The lesson here is the importance of managing that currency risk, especially for countries that are heavily reliant on foreign capital.
So strong financial regulations and responsible borrowing are key. What other debt crises does Dalio dissect in his book?
Well, fast forward to the 2010-2012 European sovereign debt crisis.
Okay.
This one started in Greece and spread like wildfire to Portugal, Ireland, Spain, and Italy, threatening to unravel the entire Eurozone.
Ah, yes, the infamous PIIG, Portugal, Italy, Ireland, Greece, Spain. I remember that crisis dominating the headlines for years. It felt like the euro was on the verge of collapse.
It was a very tense period. And what made this crisis so challenging was the structure of the Eurozone itself. You see, since these countries share a common currency, they don't have the ability to devalue their own currencies or print money to ease their debt burdens.
It's like they were all in a financial straitjacket, unable to adjust to their individual circumstances.
Exactly. And that's a crucial difference between the European crisis and that Asian crisis we discussed earlier. Asian countries could devalue their currencies, which eventually helped them regain competitiveness and recover. Europe lacked that flexibility.
So what are the key takeaways from the European debt crisis? Besides the obvious, don't get into massive debt.
What highlighted how a common currency can create challenges in managing these debt crises, especially if there are, significant economic differences between the member countries. It also reinforced the importance of fiscal discipline and sustainable debt levels.
Right.
And let's not forget the political tensions
Oh, yeah.
that added fuel to the fire.
Right. Those were some heated debates between European leaders. Disagreements on how to respond to the crisis almost made the situation worse.
Absolutely. Political factors can play a huge role in exacerbating these crises. And that leads us to one of Dalio's central arguments. These debt cycles, they're not just about economics. They're deeply intertwined with power dynamics.
That's a fascinating connection. We've been focusing so much on the economic side, but I can see how debt would play a role in, shifting global power.
It's a crucial insight. Dalio argues that these debt cycles can have a profound impact on rise and fall of empires and the balance of power between nations.
Okay, I'm all ears. Break it down for me. How does debt translate into global power?
Well, when a country's in a strong financial position, low debt, a robust economy, it has more resources to project its power abroad. Think military strength, economic influence, cultural dominance. It's like having a louder voice on the world stage.
It's like that old saying, money talks, but in this case, it's more like financial stability shouts.
Exactly. And conversely, when a country is struggling with debt, it becomes more vulnerable to external pressures and less able to assert its interests. Its influence wanes, and other players step in to fill the void.
So it's not just about the numbers, it's about the geopolitical consequences of those numbers. That adds a whole new layer of complexity to our understanding of these debt cycles.
It does.
Oh.
And Dalio uses historical examples to illustrate how these dynamics have played out over centuries.
Okay, history buff. Give me some examples. Where can we see this connection between debt and power playing out on the world stage?
Well, one classic example is the rise and fall of the British Empire. In the 19th century, Britain was the undisputed global superpower, and its strong financial position played a major role in that dominance. They had this sophisticated banking system, a stable currency, and this vast network of overseas investments.
They were the financial engine of the world, weren't they? Lending money, funding projects, essentially calling the shots?
Precisely. That financial strength allowed Britain to finance its military expansion, build a global trading empire, and project its influence across continents. But then in the 20th century, Britain's financial position began to weaken, partly due to the costs of two world wars and the emergence of new economic rivals like the United States.
So their financial power waned, and so did their global influence. It's like a company losing market share. The competition caught up, and Britain just couldn't keep pace.
That's a great analogy. And we see similar patterns in other historical examples like the rise of the Dutch Republic in the 17th century and the decline of the Spanish Empire in the 16th and 17th centuries. Debt played a key role in both those stories.
So this link between debt and power isn't just a modern phenomenon. It's a recurring theme throughout history. Which makes me wonder, how are these dynamics playing out in our current world order? Things are shifting so rapidly, and China is clearly on the rise.
That's the million-dollar question. And Dalio argues that the rise of China as a global economic and military power is intrinsically linked to these debt cycles. China has experienced this explosive economic growth over the past few decades, and it's now the world's second largest economy. They've invested heavily in infrastructure technology and, yes, their military capabilities.
It's almost like a sleeping giant has awakened and everyone else is trying to figure out how to respond. How does debt factor into this shift in power?
Well, Dalio points out that the United States, the dominant global power since World War II, is facing this growing debt burden and a relative decline in its economic strength. It's the classic story of an aging empire struggling to maintain its grip on power.
And China, meanwhile, has maintained a relatively low level of debt and continues to experience rapid economic growth. They're in a much stronger financial position to exert their influence.
Exactly. And that gives them leverage on the global stage. They can fund projects, offer loans, and shape international institutions to their advantage.
So Dalio's argument is that these debt cycles aren't just abstract economic theories. They have real-world consequences for the balance of power and the future of the global order.
Precisely. And he believes that understanding these cycles is essential for navigating the challenges and opportunities of the 21st century.
This is mind-blowing stuff. It's not just about making money or avoiding financial crashes. It's about understanding the forces that are shaping the world we live in.
It is. And it highlights why we're taking this deep dive into Dalio's work. It's not just about finance. It's about history, geopolitics, and ultimately the future of humanity.
Okay, we've covered a lot of ground in this segment. We've gone from zombie companies and currency crises to the rise and fall of empires. What are some of the key takeaways our listeners should keep in mind as we move into the final part of our deep dive?
Well, first and foremost, remember that these debt cycles are a recurring feature of economic history. They've happened in different countries at different times and for different reasons, but the underlying dynamics tend to rhyme, even if the specifics differ.
It's like that saying, history doesn't repeat itself, but it often rhymes. And in this case, the rhyme scheme can be pretty dangerous if you're not paying attention.
Exactly. These cycles can be incredibly damaging. They can lead to prolonged periods of economic stagnation, financial instability, social unrest, It's not something to take lightly.
So what can we do? Are we just at the mercy of these cycles, or are there ways to mitigate the risks?
That's the question we'll be tackling in our final segment. We'll explore what Dalio suggests we can do as individuals and societies to navigate these choppy financial waters.
Welcome back to the deep dive. We've been unpacking Ray Dalio's principles for dealing with the changing world order, focusing on his insights into debt cycles. We've seen how these cycles have shaped economies and empires for centuries, sometimes leading to those spectacular booms, and other times ending in devastating busts.
And we've explored how these cycles are really intertwined with so much more than just economics. We've talked about the psychological factors that drive them, the political tensions that they can exacerbate, and those shifts in global power that can result.
Yeah, it's been a whirlwind tour of financial history and a stark reminder that these cycles are a recurring feature of human civilization. But now the question on everyone's mind is, what can we do about it? Are we just helpless passengers on this roller coaster ride of booms and busts?
Well, Dalio argues that while we can't completely eliminate these cycles, we can become more skillful navigators. He offers a range of strategies for individuals, policymakers, and societies as a whole to not only weather the storm, but potentially use them to our advantage.
Okay, so less doom and gloom, more proactive solutions. I like the sound of that. Where do we start?
One of the most fundamental principles that Dalio emphasizes is the importance of understanding your own financial situation.
Okay.
He stresses the need to manage debt responsibly, avoid excessive leverage, and diversify your investments.
It sounds like common sense, but it's easy to get caught up in the hype, especially during those boom periods when everyone seems to be getting rich quick.
Absolutely. It's human nature to get swept up in the excitement, but that's when it's crucial to remember those cautionary tales we've discussed. Think about, those wheelbarrows full of cash in Weimar Germany, a stark reminder that what goes up can come crashing down.
So step one, don't be a sucker. Got it. But what about on a larger scale? What can policymakers do to try to mitigate these cycles?
Well, Dalio is a strong advocate for what he calls macroprudential policies. These are policies that are designed to prevent excessive risk-taking and build resilience within the financial system as a whole. Think of it as preventative medicine for the economy.
So instead of just reacting to crises after they've erupted, we're trying to get ahead of the curve and build a more stable foundation. What are some examples of these macroprudential tools?
There's a whole range of tools at policymakers' disposal. One example is adjusting reserve requirements for banks, essentially dictating how much cash they need to hold on hand. Increasing those requirements can help cool down lending and prevent those excessive credit bubbles.
So it's like putting a speed limit on the economy, making sure things don't get too out of control. What other tools are in this financial toolbox?
Another tool is capital buffers, which require banks to hold a certain amount of capital relative to their assets. This acts as a cushion to absorb losses during downturns and reduces the likelihood of bank failures.
Okay, so that's like making sure the banks have a safety net so that they're not gambling with everyone's money. What else?
Well, there are also limits on leverage, which restrict how much debt individuals and institutions can take on. This helps prevent those dangerous debt spirals that we've seen in so many of these historical examples. And then there are tools like stress tests, which simulate adverse economic conditions to assess the resilience of the financial system.
It's almost like giving the economy a checkup to identify any weaknesses before they become full-blown crises. But I imagine there are challenges in implementing these macroprudential policies. I mean, it's not as simple as flipping a switch, right?
Absolutely. One of the biggest challenges is finding that right balance. If you're too cautious, you risk stifling economic growth. But if you're too lax, you risk letting another bubble inflate.
It's that classic tightrope walk that policymakers always seem to face.
Mm.
But Dalio argues that we need to get better at this balancing act if we want to avoid those devastating boom and bust cycles.
Exactly. And he emphasizes that this requires international cooperation. These cycles are global in nature, so coordinated action is essential.
So it's not just about individual countries getting their own house in order. It's about working together to build a more resilient global financial system. But even with the best policies in place, these cycles are ultimately driven by human behavior, aren't they? What can we do on an individual level to become more financially savvy and less prone to making those classic mistakes?
Well, that's where education and awareness come in. The more people understand these cycles, the better equipped they'll be to make sound financial decisions.
Mm-hmm.
And that starts with things like financial literacy programs in schools, accessible resources for investors, and open dialogues about the risks and opportunities in the economy.
So instead of just chasing the latest investment fad, people can become more informed and make choices that are aligned with their long-term goals.
Exactly. It's about empowering individuals to be active participants in the economy, not just passive bystanders.
Okay, we've covered a lot of ground in this deep dive. We've explored Dalio's framework for understanding these debt cycles, dissected historical examples, and delved into some potential solutions. What are some final thoughts for our listeners as they process all this information?
I think the key takeaway is this. While debt cycles are a recurring challenge, they don't have to be our destiny. By understanding how they work, recognizing those warning signs, and taking proactive steps, we can navigate these turbulent waters more skillfully. We can build a more stable and resilient financial system, and perhaps break free from this boom and bust cycle that has defined so much of human history.
That's a hopeful message and one that I think is empowering. It's not about living in fear of the next crisis. It's about understanding these forces and using that knowledge to make informed decisions both for ourselves and for society as a whole.
Well said.
Okay.
And if you're interested in diving deeper into these concepts, I highly recommend checking out Dalio's book, Principles for Dealing with the Changing World Order. It's a challenging but incredibly rewarding read.
And if you're looking for a more visual introduction, his animated video, How the Economic Machine Works, is a great place to start. We'll have links to both on our website, along with a transcript of this deep dive.
And remember, this is an ongoing conversation. We'd love to hear your thoughts, your questions, and your own experiences with these debt cycles. Share your comments on our website, connect with us on social media, or send us an email. Let's keep learning and exploring together.
That's it for this deep dive. Thanks for joining us on this journey. Until next time, stay curious, stay informed, and keep diving deeper.